Hello, I'm Carl Buell, owner and managing member of Navocate Business Sales and Acquisitions. When you're considering different business intermediaries to help you sell your business, it's very important to understand how they will value your business. That's one area where Navocate really stands out because we have created our own proprietary valuation model. Our model has 4 distinguishing characteristics that help make our valuations more accurate than valuations produced by canned software packages. Those features are: first, data transparency; second, linked access to a database of real-time online industry comparable business sales; third, multiple valuation methods; and fourth, a buyer validation test. Let's take a look at each of those components now. Data transparency. Navocate's valuation model has all of the financial data on one page so that you can see the numbers, nothing's hidden, and you can complete a proper valuation. For example, you can see the annual trends in each column. You can see category trends such as revenue, cost of goods, and you can see specific line items where there might be problematic spikes or sudden decreases in expenditures. You can't conduct a thorough financial analysis and valuation if the numbers are buried. With Navocate's model, everything is transparent. Linked access to a database of comparable sales. In our Valuation tab, after we summarize all of the numbers and financials from the company, we have very simple one-click access that takes us to an online database of comparable information with almost 700 different categories of businesses. The reason this is important is because the database is constantly being updated. It's not a static database. Every day, week, and month, there's new information and fresh information. All we have to do is search by category and get the most recent comparables available. Multiple valuation methods. Navocate's valuation model doesn't just simply use one valuation or multiple method. Based on the online database of information that we have access to, we receive rules of thumb that show how different categories of businesses can sell. The model then is able to dynamically look at these different multiple methods to interpolate and come up with a range of value that is optimal for the business. Not just one valuation method, but multiple valuation methods. One of the most important and significant points of difference in our valuation model is our buyer validation process. We have 2 tabs that allow us to take a look at what a hypothetical buyer might purchase the business for. Our buyer assumptions tab allows us to input hypothetical purchase variables such as the purchase price, cash injection, whether or not there will be a seller note, what the bank financing will be, etc. Just standard assumptions about how someone might buy a business. Based on those assumptions, the buyer validation tab then runs the amortization schedule and cranks some indices to let us know very quickly if this business will be profitable for a new buyer. In this case, we're looking at a business that generates a cap rate based on net operating income of 27%. That looks pretty good. And a cash flow return on investment of 44%. That also looks terrific. This is a key point of difference, and you can't really determine what the business value will be unless you take a look at the buy-side validation.